Okay. Okay, so assessing operating management. So a firm's net profit margin or return on sales shows that the profitability of companies' operating activities. Further decomposition of firms' ROS, the return on sales, allow an analyst to assess the efficiency of firms' operating management. A popular tool used in this analysis is the common size income statement, in which all the line items are expressed as the ratio of revenue. This type of analysis is also referred to as the vertical analysis. Common size income statements make it possible compare trends in income statement relationships over time for the firm, and the trend occurs different firms in the industry. Income statement analysis allows the analyst to ask the following types of questions. First question: are the company's margins consistent with the stated competitive strategy? For example, a differentiation strategy should usually lead to higher gross margins than low-cost strategy. Are the company's margins changing? Why? What are the underlying business causes? Changes in competition, changes in input costs, or poor overhead cost management. Is the company managing its overhead and administrative costs well? What are the business activities driving these costs? Are these activities necessary? To illustrate how the income statement analysis can be used, common size income statements for H&M, Interdesk, and the other industry peers are shown in table. In table here, 5.5. The table also shows some commonly used profitability ratios. We will use the information in table 5.5 to investigate why H&M had net profit margin of 13.2% in 2014 and 13.3% in 2013. While Interdesk and the other industry peers had net margins of 13.9% and 3.9% respectively in 2014. H&M classified the expenses by function in income statement and disclose classification is experienced by nature in the notes to financial statements. In contrast, Interdesk and some of the other peers classify their expenses by nature only. Consequently, we can decompose H&M net profit margins both by function, and by nature, but can only compare expenses by nature. Decomposition by function, although not required to do so by international accounting rules. Some firms classify their operating expenses according to function. The composition of operating expenses by function is potentially more informative than the composition by nature. This is because the functional decomposition requires the firm to use the judgment in dividing total operating expenses into expenses are directly associated with the products sold or service delivered, and the expenses are incurred to manage operations. The difference between firms' revenue and cost of sales is the gross profit. Gross profit margin is an indication of the extent to which revenue exceeds the direct cost associated with sales. That is computed as the revenue minus cost sales over the revenue. Gross margin is influenced by two factors: the price premium that firms' products or service command in the marketplace, and the efficiency of firms' procurement and the production process. The price premium a firm's product or service can command is influenced by the degree of competition and the extent to which its products are unique. The firm's cost of sales can be low when they can purchase its input at a low cost than competitors, and run is the production process more efficiently. This is generally the case when firms has a low cost strategy. The table indicates HMN gross margin in 2014 decreased to 15.8%. The primary cause of decline are that HMN broadened its product range, making production more expensive, and increased its investment in information technology with the objective of stimulating the future growth and improving future margins. Because a proportion of long-term investment in IT do not have the immediate benefits, but are nonetheless immediately expenses in the income statement. They put pressure on HMM near-term margins. Given HMM strategy of selling fashion at a affordable price, the retailer couldn't easily compensate for its higher cost of sales by raising its selling price. The negative effect product range changes and long-term investment were partly offset by at least two positive development in 2014. Decreasing cotton price lowered the production cost of fashion manufacturers and thus made it less expensive for HMN to source its product. Further, because consumer demand for HMN products picked up, the retailer marked down the inventories less frequently than in 2013. A company selling general and administrative expenses are influenced by operating activities. He has to undertake to implement its competitive strategy. Discussed in Chapter 2, firms with differentiation strategy have to undertake activity to achieve differentiation. A company competing on the basis quality and repeat introduction of new products is likely have a higher R&D cost related to a competing purely on a cost basis. Similarly, a company that attempts to build a brand image distribute its product to full service retailers and provide a significant customer service is likely to have higher salary and administration costs related to a company that sells to warehouse retailers or the direct mail and does not provide much customer support. A company's SG&A expenses are also influenced by the efficiency with which it manages its overhead activity. The controlled operating expenses is likely to be especially important for firms competing on the basis of low cost. However, even for differentiators, it's impossible to assess whether the cost of differentiation is commensurate with the price premium earned in the marketplace. The ratio SG&A expenses to revenue in table the table allow us to evaluate the effectiveness with which HMN manages the SG&A expenses. This ratio shows how much the company is spending to generate each euro of revenue. In 2014, HMS SG&A to expend is to the revenue ratio decreased from 41.2 to 41.1%. Tempting management to stay in its post-earnings conference call with analysts that the company had kept its SG&A in control. However, the important factor to consider when interpreting the SG&A to revenue ratio is stickiness of the SG&A expenses. In particular, in periods during which revenue per store decline, changes in selling expenditure typically lag behind revenue changes. Thus, increasing ratio of this cost to revenue. Conversely, in times when sales pick up, excess sales capacity may get utilized, helping to decrease the ratio of SG&A cost to revenue. Stimulus SG&A expenses occurs because it's costly for firms to temporarily cut capacity in down periods and bring back capacity when the sales recover. For example, in many countries, labor regulations make it difficult to lay off the personnel. Also, temporarily cutting back on personnel could be difficult in stores that require minimum amount staffing to function efficiently, or raise the concerns about finding adequate replacement in the future. To illustrate the effect, cost stealers consider HMN revenue and SGM expenses on per store. In 2013, revenue per store decreased by almost 5.5% from 14.6 million to 14.3.5 per store, the million. However, the ratio of SG&A to average number of stores operated decreased less by only 3.1% from 18.5 million to 17.9 million. This observation signals HMM management was not able to cut back sufficiently on its sales capacity following the drop in consumer demand. As a consequence, the SG&A to revenue ratio went up in 2013. The observation also led us to expect 1 year later, when the consumer demand improved in 2014, HMN's management should have been able to use its excess sales capacity and consequently lower the company's SG&A to revenue ratio. The effect that management was not able to do so can possibly be attributed to impact HMM increased long-term investment, online activity, and the new store on its SG&M expenses. Note that a retailer's expenditure on procurement can be just as sticky as selling expenditure. However, procurement costs that are relative to unsold products end up on the firm's balance sheet as purchased inventories. The temporary capitalization of these costs dampens the positive effect of revenue decline on the cost of sales to revenue ratio. Although it is to increase in the inventory to revenue ratio, we will return to the issue in the session on the asset turnover. The international accounting rules require all firms reporting under IFRS classify and disclose their operating expenses by nature, either in income statement or in the notes to the financial statements. Like most firms, HMM Index and the other industry peers distinguish four expenses categories. Okay. Cost of materials, personnel expenses, depreciation, amortization, and other operating expenses. So the table 5.5 indicates that HMN experienced a small decrease in personnel expenses in 2014. As argued earlier, this possibly because personnel expenses tend to exhibit stickiness in the presence of revenue per store decline, such as in 2013, given that it's costly to let off the personnel and often difficult to cut salaries. As a consequence of the side cost stickiness, the personnel expenses to revenue ratio tends to improve again when the revenues rebound, as they did in 2014. The decrease in personnel costs improved the operating margins by the 0.2 percentage points. In 2014, Intertex spent on the average 21.4 thousand per employee, up to 1.8% from 21,000 per employee in 2013, which illustrates the company had less expenses for workforce than HMM. The difference in average cost per employee between HMM and the Intertex can be partly attributed to the fact that Intertex operates its own manufacturing facilities, and thus the employ more low-cost production employees than HMM. Because of this, the manufacturing activities, Intertex also needs a larger workforce than HMM, making the Intertex the average employee productivity significantly lower at 132,000 in the revenue per employee. HMM experienced a decrease in its depreciation and amortization expenses, roughly 0.3%. However, with the value of 13.9%, HMM's depreciation and amortization to revenue ratio remains notably higher than that of Intertex. The depreciation difference between the retailers is consistent with the observation that Intertex is able to generate a higher amount of revenue than HMM from a smaller investment base. As we will see discussed in more detail in the next section, HMM and Intertex depreciation and amortization to revenue ratios are significantly higher than those of their other industry peers. One factor explaining this is that HMM and the Intertex tend to lease their stores at more central and hence more expensive locations. Because we capitalize these assets following the method discussed in Chapter 4. Before calculating ratios, the higher lease payments that HMM and the Intertex make are inflated in the higher depreciation and amortization to revenue ratios. HMM saw its cost of materials to revenue ratio increase in 2014 from 40.5 to 14.8%. When we compare HMM with Intertex cost of materials, we see that HMM cost of materials as percent of revenue is lower. This difference between the two retailers is somewhat surprising, given the HMM purchase only finished products, whereas the Intertex purchase both the finished products and the raw materials, which used is the production. Further, Intertex the greater presence in higher price segment, the apparel industry, should allow the company to have a greater average price make up on its raw products than HMM. The difference is in cost of materials confirms that HMM has comparatively cheap suppliers, often in lower wage country, making its outsourcing strategy relatively cost efficient compared with the indirect strategy to sell the manufacture part of its assortment and concentrate production in Europe. Decomposing asset turnover. Asset turnover is the second driver of a company's return on equity. Since firms invest considerable resources in their assets, using them productively is critical to overall profitability. A detailed analysis of asset turnover allows the analyst to evaluate the effectiveness of firms' investment management. There are two primary areas of asset management: working capital management and management of non-current operating assets. Working capital is defined as the difference between a firm's current assets and the current liability. However, the definition does distinguish between operating components such as the trade receivable, inventory, and the trade payable, and the financing and investment components such as excess cash, marketable security, and the notes payable. An alternative measure that makes this distinction is operating working capital, as defined in the table. Okay, 5.3. Okay, so working capital management, the components of operating working capital that analysts primarily focus on are trade receivables, inventories, and trade payables. A certain amount investment in working capital is necessary for the firm to run its normal operations. For example, a firm's credit policy and the distribution policy determine its optimal level of the trade receivables. The nature of production process and the need for buffer stock determine the optimal level of inventories. Finally, trade payables are a routine source of financing for the firm's working capital, and payment practice in the industry determine the normal level of trade payable. Operating working capital to sales ratios. The definition of these ratios as follows. Okay. So the first one, the operating working capital over revenue. Okay, operating working capital turnover, that's defined by revenue by over operating working capital. Trade receivable turnover defined by revenue over trade receivables. Inventories turnover defined by the cost of sales by inventories. Trade payable turnover defined by the purchase by trader payable. Days inventories. Days receivables defined by the inventories by average cost of sales per day, and the trade receivables over average revenue per day, respectively. Okay, so table 5.6 shows that the asset turnover ratio for HMM, index, and their peers. Between 2013 and 2014, HMM become more efficient in its working capital management, as can be seen from the decrease in operating working capital as a percentage of revenue and increase in operating working capital turnover. Working capital management improved because of increases in trade receivable turnover and inventory turnovers. The increase in inventories turnover is consistent with the information disclosed by HMM that because of improved consumer demand, it experiences less difficulty in selling its products and lead to markdown its inventory less frequently in 2014. HM non-current operating asset utilization slightly worsened in 2014. Both its net non-current operating asset turnover and its PB&E turnover decreased, albeit marginally. This small decrease in turnover signal that HMM increased focus on higher margin activities, such as the through investment in new brand, may force its management to make greater investment in non-current assets and consequently accept lower the turnover. Financial leverage analysis. Okay, financial leverage enables a firm to have an asset base larger than its equity. The firm can augment its equity through borrowing and the creation of other liabilities like the trade payable, provisions, and deferred taxes. Financial leverage increases a firm's ROE as long as the cost of liability is less than return from the investing this firm. In this respect, it is important to distinguish between interest-bearing liabilities such as notes payable, other forms of current debts, and non-current debts that carry illicit interest charge, and other forms of liabilities. Some of these other forms of liabilities, such as trade payable or deferred taxes, do not carry any interest charge at all. Other liabilities such as finance lease obligations or pension obligations carry an implicit interest charge. While financial leverage can potentially benefit a firm's shareholders, they can also increase their risk. Unlike the equity, liabilities have predefined payment terms, and the firm faces risk of financial distress if it was to meet these commitments. There are a number of ratios to evaluate the degree of risk arising from a firm's financial leverage. Current ratio defined by the current assets by current liabilities. Quick ratio defined by cash and cash equivalent plus the trade receivables over the current liabilities. Cash ratios defined by cash and cash equivalent by the current liabilities. Operating cash flow ratio defined by cash flow from operations over current liabilities. All these ratios attempted to measure the firm's ability to repay its current liabilities. The first three compare a firm's current liabilities with its current asset that can be used to repay those liabilities. The first ratio focuses on the ability of firm's operations to generate the resources needed to repay its current liabilities. Since the current assets and the current liabilities have comparable duration, the current ratios is a key index of firm's short-term liquidity. Analysts view a current ratio more than one to be an indication that the firm can cover its current liability from the cash realized from the current assets. However, the firm can face a short-term liquidity problem even with a current ratio existing one, when some of its current assets are not easy to liquidate. Further, firms whose current assets have higher turnover rates, such as food retailers, can afford to have the current ratios below 1. Quick ratio and cash ratio capture the firm's ability to cover its current liability from liquid assets. Quick ratio assume that firm's trade receivables are liquid. This is true in industry where the credit worthiness of customers is beyond dispute, or when the receivables are correct in a very short period. When these conditions do not prevail, cash ratio, which considers only cash and cash equivalent, is better indication of firm's ability to cover its current liabilities in the emergency. Operating cash flow is another measure of firm's ability to cover its current liabilities from the cash generated from operations of firm. Liquidity ratios for HMN indexes and their peers are shown in table. Okay, in next table. Okay, here. The firm's and Intertex liquidity situation in 2014 was comfortable thanks to their large cash balance and sound operating cash flows. Most of the retailers' liquidity ratios worsened in 2014, but remain at acceptable levels. Also in 2014, the industry peers' current and quick ratios are significantly lower than those of HMN and the index. Debt at the long-term solvency. A company's financial leverage is also influenced by its debt financing policy. There are several potential benefits from the debt financing. First, debt is typically cheap than equity because the firms promise predefined payment terms to debt holders. Second, in most countries, interest on debt financing is tax deductible, whereas dividends to shareholders are not tax deductible. Third, debt financing can impose discipline on the firm's management and motivate it to reduce wasteful expenditures. Fourth, it is often easier for management to communicate their proprietary information on the firm's strategies and the prospect to private lenders than to public capital markets. Such communication can potentially reduce a firm's cost of capital. For all these reasons, it's optimal for firms to use at least some debt in their capital structure. Too much reliance on debt financing, however, is potentially costly to the firm's shareholders. The firm will face financial distress if defaults on the interest and the principal payments. Debt holders also impose covenant on firm, restricting the firm's operating, investment, and financing decisions. The optimal capital structure for a firm is determined primarily by its business risk. A firm's cash flow are highly predictable when there is little competition and or there's a little threat of technological changes. Such such firms have low business risk and hence they can rely heavily on the debt financing. In contrast, if firms' operating cash flows are highly volatile and its capital expenditure needs are unpredictable, it may have to rely primarily on equity financing. Managers' attitude to risk and financial flexibility also often determine a firm's debt policies. There are a number of ratios that help the analyst in this area to evaluate the mix of debt and equity in a firm's capital structure. The following ratios are useful: the liability to equity ratio, debt to equity ratio, and debt to capital ratio. The first ratio is debt asset to equity ratio by subtracting one from it. The second ratio provides an indication of how many euros the debt financing the firm is using for each euro invested by shareholders. The third ratio measures the debt as a proportion of total capital. In calculating all the above ratios, it is important to include all interest-bearing obligations, whether the interest charge is explicit or implicit. Recall the examples of line items that carry an implicit interest charge, include finance obligations and pension obligations. Analysts sometimes include any potential of balance sheet obligations that a firm may have, such as non-cancelable operating leases in the definition of firm debts. We discussed the method to do so in Chapter 4. The ease with which a firm can meet its interest payment is an indication of degree of risk associated with this debt policy. The interest coverage ratio provide a measure of this construct. Interest coverage, the profit or loss plus interest expenses plus tax expenses over the interest basis. Interest coverage, another indication. There is the cash flow from operations plus interest paid plus taxes paid over the interest paid. The earning base coverage ratio indicates the euro earnings available for each euro of required interest payments. The cash flow based coverage ratio indicates the euros of cash generated by operations for each euro of required interest payments. In both these ratios, the denominator is the interest expenses. In the numerator, we add a taxes back because taxes are computed only after interest expenses is deducted. A coverage ratio of 1 implies that the firm is barely covering its expenses, interest expenses through its operating activities, which is a very risky situation. The larger the coverage ratio, the greater the cushion the firm has to meet interest obligations. One can also calculate debt coverage ratios, measure a firm's ability to measure or fix the financial obligations, such as interest payment, lease the payments, and the debt repayments by appropriately redefining the numerator and the denominator in the above ratio. In doing so, it is important to remember that while some fixed charge payments, such as interest and lease rentals, are paid with the pre-tax euros, others, such as the debt repayments, are made with after-tax euros. A debt coverage ratio that takes account of the tax deductibility of the interest and the lease payments is the following. Okay, sustainable, the growth rates. Okay, so analysts often use the concept sustainable growth rate as a way to evaluate firms' ratios in comprehensive manner. A firm's sustainable growth rate is defined as the ROE times the 1 month dividend payout ratio. We have already discussed the analysis of ROE in the previous 4 sessions. The dividend payout ratio is defined as the cash dividends paid over profit or loss. Sustainable, okay, the growth rate measures. Firm's dividend payout is the measure of dividend policy. Firms pay the dividends for several reasons. They provide a way for firm to return to its shareholders any cash generated in excess of the operating and investment needs. When there are information asymmetry between the firm's managers and the shareholders, dividend payments can serve as a signal to shareholders about the manager's expectation of its firm's future prospects. Firms may also pay dividends to attract a certain type of shareholder base. Substance growth rate is the rate at which a firm can grow when keeping its profitability and financial policy unchanged. A firm's return on equity and its dividend payout policy determine the pool of funds available for growth. Of course, the firm can grow at a rate different from its sustainable growth rate if it is the profitability payout policy or financial leverage change. Therefore, sustainable growth rate provide a benchmark against which a firm's growth plans and can be evaluated. Figure 5.2 shows how a firm's sustainable growth rate can be linked to all the ratios discussed in this chapter. This linkage allowed analysts to examine the drivers of the firm's current sustainable growth rate. If the firm intends to grow at a higher rate than its sustainable growth rate, one could assess which ratios are likely to change in process. The analysis can lead to asking business questions such as this. Where is the change going to take place? Is management expecting profitability to increase or asset productivity to improve? Are these expectations realistic? Is the firm planning for these changes? If the profitability is not likely to go up, will the firm increase its financial leverage or cut dividends? What is the likely impact of these financial policy changes? Conflict of interest between managers and shareholders can also have implications for dividend policy decisions. Shareholder firm with higher profit and free cash flow and few predictable investment opportunities want managers to adopt dividend policy with higher payout rates, thus reducing the sustainable growth rate. This will deter managers from growing a firm by investing in new projects that are not valued by shareholders or from spending the free cash flow on management perk. If the firm's sustainable growth rate is much higher than warranted by firm's growth opportunities, one could evaluate the possible reasons for why management has not changed its dividend policy. Is management expecting profitability to decrease? If the profitability is not expected to decrease, has the firm reduced or will it reduce leverage? Are there contractual or legal constraints preventing a firm from paying higher dividends? Okay, so the table shows the sustainable growth rate and its components for HMN and its peers. In 2013 and 2014, HMN had a lower ROE but also a higher dividend payoff ratio than the index, leading to a lower sustainable growth rate. HMN's sustainable growth rate in 2013 was lower than the company's average growth rate and during the period. Cash flow analysis. The ratio analysis discussion focus on analyzing a firm's income statement or its balance sheet. The analyst can get further insights into firm's operating, investing, and financing policies by examining its cash flows. Cash flow analysis also provide an indication of the quality of information in the firm's income statement and the balance sheet. As before, we will illustrate the concept discussed in this section using HMN and indicates cash flows. All companies reporting in conformity with IFRS conformity are required to include statement cash flows in their financial statement under IS 7. In the reported cash flow statement, firms classify their cash flows into three categories. Cash flow from operation, cash flow related to investment, cash flow related to financing activities. Cash flow from operations is the cash generated by firm from the sales of goods and service after paying for the cost of inputs and operations. Cash flow related to investment activities shows the cash paid for a capital expenditure into corporate investment acquisitions and the cash from the sale of non-current assets. Cash flow related to financing activities shows that the cash raised from firms shareholders and the debt holders. Firms used to cash flow statement formats, the direct format and the indirect format. The key difference between the two formats is way they report cash flow from operating activities. In the direct cash flow format, which is used by only a small number of firms in practice, operating cash receipts and disbursement are reported directly. In the indirect format, firms derive their operating cash flow by making accrued adjustment to profit or loss. Because the indirect format links the cash flow statement with the firm's income statement and the balance sheet, many analysts and managers find the format more useful. You may recall from Chapter 3 that profit or loss differs from operating cash flows because revenue and expenses are measured on an accrued basis. There are two types of accruals embedded in profit or loss. First, there are current accruals like credit sales and unpaid expenses. Current accruals result in changes in the firm's current assets and the current liabilities. The second type of accruals include the income statement is non-current accruals such as depreciation, deferred taxes, and equity income from unconsolidated subsidiaries. To derive cash flow from operations from the profit or loss, adjustments have to be made for both these types of accruals. In addition, adjustments have to be made for non-operating gains include in gain or loss, such as profit from assets sales. Okay. The indirect cash flow format explicitly detail the accrued adjustment that needed to be made to profit or loss in order to arrive at operating cash flows. If firms use the direct cash flow format, it is useful for analysts to know how to prepare an approximate indirect cash flow statement. The first step to doing so is to calculate firms' working capital from operations, defined as profit or loss adjusted for non-current accruals and gain from the sale of non-current assets. Information about non-current accruals such as depreciation and deferred taxes or non-operating gains can typically be taken from the income statement or the notes to financial statement. Second step is to convert working capital from operations to cash flow from operations by making the relevant adjustment for current accruals related to operations. Information on current accruals can be obtained by examining changes in a firm's current asset and the current liability. For example, the change in inventory can be seen as representing investment in current assets that is not yet recognized as expenses. The change is then included in the cash flow from operations, but not in private orders. Typically, operating accruals represent changes in all the current asset accounts other than cash and the cash equivalent. And the changes in all the current liability other than notes payable and the current portion of non-debt. The working capital from operations increase the minus increase in tradable receivable, minus increase in inventories, minus increase in other current assets excluding cash and cash equivalents, plus increase in trade payable, plus increase in other current liability excluding debt. In most cases, working capital from operations adjusts for changes in the balance sheet value of current assets and the liabilities. Will not be exactly equal to operating cash flow disclosed in the direct cash flow statements. Therefore, the analyst needs to add a category of other unspent accrued to the constructed indirect cash flow statement to make a operating cash flow in the two cash flow statements match. This complication arises because year-to-year changes in the balance sheet value of current assets and liabilities are affected by events such as changes in consolidation of or foreign currency exchange rate changes, whereas the current occur in the indirect cash flow statement or not. Cash flow analysis can be used to address a variety of questions regarding firm's cash flow dynamics. First one, how strong is the firm's internal cash flow generation? Second one, does the company have ability to meet its short-term financial obligations, such as interest payment from operating cash flows? Can it continue to meet these obligations without reducing its compliance flexibility? Third one, how much cash did the company invest in growth? Are these investments consistent with its business strategy? Fourth one, did the company pay dividends for internal free cash flow, or did it have to rely on external financing? Fifth one, what type of external financing does the company rely on? Equity, current debt, or non-current debt? Last one, does the company have exercised the cash flow after making capital investment? It is a long-term trend. What plan does management have to deploy the free cash flow? Okay, so the concluding, so concluding is that the chapter presents the two tools of financial analysis. ratio analysis, and the cash flow analysis. Both these tools allow the analyst to examine a firm's performance and his potential condition, given its strategy and goals. Ratio analysis involves assessing the firm's income statement and the balance sheet data. Cash flow analysis relies on the firm's cash flow statement. The starting point for ratio analysis is the company's ROE. The next is to evaluate the three drivers of ROE, which are the net profit margin, asset turnover, and the financial leverage. Net profit margin reflects a firm's operating management. Asset turnover reflects is the investment management, and the financial leverage reflect its liability management. Each of these areas can be further probed by examining a number of ratios. For example, common size income statement analysis allows a detailed examination of firm's net margins. Similarly, turnover of key working capital accounts like accounts receivable, inventory, and accounts payable, and turnover of firm's fixed assets allow the further examination of the firm's asset turnover. Finally, short-term liquidity ratios, debt policy ratios, and coverage ratios provide a means of examining a firm's financial leverage. A firm's sustainable growth rate, the rate at which it can grow without altering its operating, investment, and the financing policies, is determined by its ROE and its dividend policy. The concept of sustainable growth provide a way to integrate the ratio analysis and to evaluate whether or not a firm's growth strategy is sustainable. If firm's plans call for growing at a rate above its current sustainable rates, then the analyst can examine which of the firm's ratios is likely to change in the future. Cash flow analysis supplement ratio analysis in examining firm's operating activity, investment management, and the financial risk. Firms reporting in conformity with IFRS are currently required to report a cash flow statement summarizing their operating, investment, and financing cash flows. Since there are wide variations across firms in the way cash flow data are reported, analysts often use the standard format to recast cash flow data. We discussed in this chapter such cash flow model. This model allows the analyst to assess whether a firm's operations generate the cash flow before investment, operating working capital, and how much cash is being invested in the firm's working capital. It also enables the analyst to calculate firm's free cash flow after making long-term investment, which is an indication of firm's ability to meet its debt and the dividend payments. Finally, the cash flow analysis shows how the firm is financing itself. and whether its financing patterns are too risky. The insight gained from analyzing firms' financial ratios and its cash flows are valuable in forecast of the firm's future prospects. Okay, this is our introduction of the chapter 5. So next we okay, so maybe I think we see maybe the this month 24, because next week is our midterm test, right? And next week we have to I have to go for accreditation for ASSB. So we have to cancel our class the next week. So I think I see you next time. The date and the time I think is the November 24th, right? Okay, so any questions? Hello?
So far, so good, sir.
Okay, so no
No,
questions. Okay, so waiting for my midterm test. Okay, okay. So any questions you can ask me, and please, if you you know your friend in my class, but he not yet and enter use their line ID to enter our line group, please you can help me to invite them to join our line group, because for me it's very convenient to announce, to communicate with students, yeah, for something. Okay, yeah, okay, thank you. So no questions, right?
No
Okay,
questions.
okay, no questions. See you next time. Bye bye.
Thank you, sir.
thank you, Professor.